Hey there, financial explorers, and welcome back to the channel where we decode the fascinating world of hard-to-borrow stocks and short squeezes. Today, we're zooming in on a specific name that's been lighting up our screeners, ZCMD, or Zhongchao Inc. We're going to break down why this microcap healthcare stock is drawing attention, what its hard-to-borrow status means, and what factors potential traders need to consider. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's get straight into it. ZCMD Zhongchao Inc. operates in the healthcare information services sector within the People's Republic of China. Show company logo/stock chart. They provide healthcare information, education, and training services primarily under their endemic brand, and also have a segment for sales of patented drugs. This is a very small company with a market cap of just $2.05 million. Looking at the charts, ZCMD has had a wild ride recently. After a massive drop of -98.35% over the last 30 days, we've seen a dramatic rebound, with the stock up an incredible plus 109.52% in just the last 5 days. Today, it's seeing a minor pullback, down -1.79%, but the overall volatility is undeniable. What is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? When a short seller wants to bet against a stock, they first have to borrow shares from someone who owns them. They then sell those borrowed shares hoping to buy them back later at a lower price to return them, pocketing the difference. But borrowing isn't free. Brokers charge a fee, known as the cost to borrow, or CTB. This fee is expressed as an annualized percentage. The higher the demand to short a stock and the fewer shares available to borrow, the higher the CTB fee can climb. When CTB rates exceed 100%, it means it's becoming extremely expensive to maintain a short position over a year. Why this stock is hard to borrow right now. And this is where ZCMD gets interesting. Right now, ZCMD's annualized cost to borrow fee is an astronomical 758.8%. Highlight CTB FE. Not only is it high, but the CTB momentum has surged by an astounding plus 649 percentage points over the last 5 trading days alone. This tells us that the cost to short ZCMD has skyrocketed very quickly. To further emphasize the scarcity, there are currently only about 5,000 shares available to borrow against an estimated float of 1.1 million shares. Our internal composite squeeze score, which combines factors like CTB level, CTB momentum, shrinking borrow supply, and float size, currently gives ZCMD a score of 61.2 out of 100. This confluence of factors points to a significant increase in the cost and difficulty of shorting Zhongchao Inc. Squeeze mechanics explained. So, what happens when a stock becomes this expensive and difficult to short? This is where the short squeeze potential comes in. As the cost to borrow continues to climb and the supply of shares dwindles, short sellers face increasing pressure. If the stock price starts to rise, even slightly, their losses mount quickly due to the upward price action compounded by those hefty borrowing fees. This can force some short sellers to cover their positions, meaning they have to buy back shares in the open market to return them to their lenders. This buying pressure, in turn, can push the price even higher, trapping more short sellers and creating a cascade of forced buying, the classic short squeeze. It's crucial to remember, however, that a high CTB doesn't guarantee a squeeze. It could also mean short sellers have very strong conviction that the price will ultimately fall, and they're willing to pay the high fees to maintain their positions. Dilution risk check. Now, let's talk about a significant factor that can impact any squeeze thesis: dilution. Our screening shows that ZCMD has had a registration statement license -10-3 filed with the SEC within the last 90 days. This is a dilution risk flag. What does dilution mean for you? It means the company might be preparing to issue new shares to raise capital. While raising capital isn't always bad, if ZCMD floods the market with new shares, it increases the total number of shares outstanding. This can effectively dilute the value of existing shares and counteract any upward price pressure from a short squeeze, essentially providing more shares for short sellers to cover with, or for new short sellers to borrow, undermining the scarcity factor. Recent reverse split watch. Another critical recent event for ZCMD is its 1-for-3 reverse stock split, which occurred just 8 days ago on June 29, 2026. A reverse split reduces the number of outstanding shares and proportionally increases the share price. So, for every 3 shares an investor held, they now have 1, but that 1 share is theoretically worth 3 times as much. While reverse splits often occur with struggling micro-cap companies to boost their share price above minimum exchange requirements, it's a historical pattern and not a guarantee that many micro-cap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market re-evaluates the new share structure and reduced float. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, if you're tracking ZCMD, what should you keep an eye on? Continue to monitor the cost to borrow fees and, critically, the number of shares available to borrow. If that 5,000 share count continues to drop or stays critically low, the pressure on short sellers intensifies. Also, watch the daily trading volume. Today's volume for ZCMD is around 1.79 million shares, which is about 0.5 times its 30-day average volume of 3.43 million shares. To a volume pause, any significant increase in buying volume, especially above its average, could indicate growing interest and potentially exacerbate a squeeze. Finally, keep an eye out for any news regarding ZCMD's operations or any further SEC filings related to potential dilution. ZCMD, is clearly on the radar due to its incredibly high and rapidly rising cost to borrow, extremely limited share availability, and a recent reverse split that might contribute to post-split volatility. While these are all significant factors for a potential short squeeze, remember the dual risks of potential dilution and the strong conviction of existing short sellers. This stock presents a complex scenario, requiring careful due diligence. If you found this breakdown helpful, please smash that like button, subscribe for more in-depth analysis of hard-to-borrow stocks, and let us know your thoughts or any questions about ZCMD in the comments below.